So, as I had stated earlier at the beginning, as we're going through everything, Trevor is one of my favorite people in the world, and we had promised to conquer Cedar City together, and he gave up and went to conquer St. George and the country, and left me. But I'm not bitter at all. Um, so, but I really appreciate him. I'm excited. Like I said, last year his rate presentation history was awesome. So let him kind of discuss that, but then also discuss a little bit on reverse mortgages, because many of you guys have kind of talked about different things with you guys as you move into the future financially, and ideas and options to help you. And he is the best in the business. So without further ado, I'll turn the time over to Trevor.
Awesome. Thanks, Derek. I appreciate it, man. So yeah, I did. I gave up on Cedar City. It was just too windy. It shook me. So but yeah, I appreciate this opportunity. This year we're going to focus specifically on reverse mortgages. Last year, as Derek mentioned, we talked about interest rates and the predictions we had for the market. Unfortunately, I was about 9 months. The market was about 9 months too slow on doing what I said it would do. But things are starting to happen the way we had expected. They were just slower than we expected. But the reason I wanted to focus specifically on reverse mortgages today, partly is because, of course, that's what I do. It's my specialty. It's the only thing we do as professionals at my company. But more and more, we're seeing the need grow for this product. And so for you as homeowners, in your circle of influence of the people that rent from you, or the people in your influence, you're likely seeing that inflation is really becoming a real nightmare for a lot of people. And so hopefully this will provide some clarity and information that you can share with others that may improve their lives. And so let's go ahead and jump right into that if you want. Sarah, do you want to open up the presentation or the PowerPoint?
Or if you want to share.
Sorry, what was that?
Oh, if you want to share your slide.
Oh, can I share it from my side?
Yeah, you can share them.
Great, let's do that then. All right. Okay, are you able to see my screen now?
Yeah, we are.
Okay, perfect. So as I mentioned, my name is Trevor Carlson. I've been in mortgages since 2006. I started a Heritage Reverse Mortgage in 2016, and all we do is reverse mortgages now. And the reason for that is that I found when I began doing reverse mortgages that it was the most effective way for me to truly impact somebody's life and help somebody to live dramatically better. Versus any other mortgage product out there. This is the one that I think has the ability to really make a difference in people's lives. And so, going off of that vein, a couple of years ago, I read a book, the biography by Steven Schwarzman, and one of the things that still I keep in my mind today is one of the quotes in the book. Is he says that if you want to be successful in life, if you want to make a difference in the world, you need to find a big problem and solve it. The bigger the problem, the bigger the reward. And so for me, the problem in America is retirement. And so let's kind of talk about some of those details and why I'm concerned about retirement in America. Statistically, about 4 million people in America retire. Now, we have somewhere around 330 million citizens in this nation, and so 4 million isn't that big of a deal. And so considering that's, if you look at birth rates through the 70s and stuff, we're expected that we'll probably be somewhere between 3, 4, 5 million for the next decade or so. So essentially 11,000 people every single day enter retirement. And as I mentioned, that makes sense with how many people live in this country. And so the number of people that are retiring isn't really the issue. The issue is how these people are retiring. So these next statistics come from Social Security. Over 60% of retirees rely on Social Security as their primary source of income. And the average check from Social Security last year was about $1,705. So if you want to do the math on that, that tells us that 2/3 of all retirees are living on a fixed monthly income of about $3,400 or less. And I can tell you from experience, lots of experience, that it is more often much less. It breaks my heart that often we have clients come in that are surviving on $1,100 or $1,200 a month fixed income for the rest of their lives. And to consider how they're surviving and how they're doing it, it just doesn't make sense. And I do this for a living, but it definitely is an issue. Going a step further, this was an article posted in Forbes last year. This said that in 2019, the median net worth of retirees was $266,000 in 2019. And of that, $240,000 of it was locked up in their homes. And so I want you to imagine what this looks like. This is life expectancy over the past century, since 1900 until 2010. When Social Security was implemented in 1935, the average life expectancy was 59. So for somebody who actually lived long enough to qualify to get Social Security, they were already past their expiration date. The government didn't expect us to live into our 70s and 80s the way we're doing now. And so imagine somebody at 60-something years old today, they're retiring tomorrow, they can expect a $2,000 to $3,000 fixed income for the rest of their lives, and they might have $20,000 in the bank. And so this is why I say retirement is a problem, because this is the problem. This is why, more and more as you're going to Walmart or Culver's or McDonald's or whatever, we're seeing people in their 70s and 80s working. It's not because they're still trying to climb the corporate ladder and because they get a thrill of flipping burgers. It's because they're trying to make ends meet. They're trying to survive in a system where retirement is broken for them. So let's figure this out. What's happening here? What does our financial planner tell us to do to prepare for retirement? Number one, live within your means. Number two, invest some of your excess income every month into something safe and secure, something that earns you, 5 to 10% return consistently over time. And the more you can invest, the more you'll have later when you do retire. So here's the question. Statistically, how many people are really doing this, right? The answer, most people are doing this. Because even though retirees in America are not doing well financially in terms of an asset, liquid asset or monthly income basis, they are absolutely doing well on an asset, a total overall asset basis. Because think about this, when you go to make a mortgage payment, and in when I do seminars and conferences and we talk about this, this is one of the questions I ask, is that when you go to make a mortgage payment, you're paying principal, you're paying interest, you're paying taxes, you're paying insurance, right? We kind of know where all of those things go. So who gets the interest of your mortgage payment? The bank does. Who gets the taxes? The county does. Who gets the insurance? The insurance company does. But who gets the principal? You do. It's as if you're taking money out of one pocket and putting it into the other pocket. You're taking money from your checking account and you're putting it back into your home's equity. You have not lost that money. And that's essentially what's happening when people make a home mortgage payment for 10, 20, 30, 40 years. They're taking $200, $300, $400, $500 a month, and they're storing it into a sound investment that's earning 5 to 10% return consistently over the period that they own that home. And so most Americans have a retirement account in their home. They just don't understand that it can be used that way. In fact, the statistic for homeowners that own their homes in retirement is roughly about 78%. The vast majority of people in retirement own their own home. The solution to help them access this money is HECM'S, or reverse mortgages. Home equity conversion mortgages is the official term. Let's talk about the key benefits of why HECM'S could be the game changer, or the solution for these homeowners that are struggling. The first benefit is that you're able to eliminate a monthly mortgage payment. Now, they continue to pay the property taxes, the insurance on the home, as a homeowner, those will always be required, right? It doesn't matter what kind of mortgage you have, where you live, whether you have a mortgage or not, you got to pay your property taxes or the county is going to foreclose on you. And the same goes for reverse mortgages. Homeowners that have extra or have equity in their home are able usually to pull some of that equity out. They can consolidate other debts, pay off a car loan, a credit card, and again, further reduce the monthly burdens that they're feeling from their debts and expenses. Number three, and we're going to go into this quite a bit because I think with this audience, the growth line of credit is something that will seem very beneficial and impactful in terms of how people can use this to grow their assets, to grow their wealth. But again, if somebody has enough equity in their home, they're able to put that equity into a line of credit they can draw similar to a home equity line of credit. But we'll come back to that in just a moment. Likewise, as I mentioned, they can draw large amounts of funds if they want to go on a vacation, if they need to pay a $20,000 health expense, if they want to send a kid to college. Those are some of the benefits that people can experience with doing a reverse mortgage and using the asset and the equity that's in their home, but still own the home and maintain the home for the rest of their lives. So how mechanically do reverse mortgages work? This is one of the key points that I try to help people understand, because most people think reverse mortgages are complex or confusing. It's a scam, it's a this, it's a that, you know what I mean? And so very simply, I just try to help people understand the very basics of what a reverse mortgage is. Number one, well, let me back up. The easier way to explain this is, let's compare the two. Let's compare a reverse mortgage to a conventional mortgage and see how they're different. So with a conventional 30-year fixed mortgage, the basic mechanics are you go to a bank, you borrow money, you buy a home, and the agreement is that the bank's going to charge interest on the amount of your mortgage or your loan balance until you pay them off. Now, traditionally, that means that every month you're going to make a payment that's going to pay down a little bit of the principal. It's going to pay that monthly interest that was charged. And so little by little over time, your mortgage trickles down to zero until you pay it off. The only difference with reverse mortgages is that your payment becomes optional. That means that if you want to make a monthly payment, excellent, go ahead, make it. You get the exact same benefit. You'll pay this loan off in 30 years if you really wanted to. But the point for most people is that with a reverse mortgage, you never have to make a monthly mortgage payment. As long as you live in the home, as long as you pay your property taxes and insurance, you do not have to make a payment to the bank. They're still going to charge interest just like any other loan, but instead of charging that in a payment to you, they will add that interest charge onto the balance of the mortgage. And so over time, that's the key difference, is that instead of your mortgage slowly trickling down to nothing, your mortgage slowly trickles up until you either sell the home or you pass away. And then at that point, the exact same thing happens. Once the homeowner passes away, the family inherits the home. They have the option to refinance the home, to sell the home and keep whatever equity is left over. But the home always belongs to the homeowner and their family. They don't lose it. They're not giving it away. The bank's not taking it from them and letting the homeowner live in the home. The home belongs to them. The only difference is how interest is handled with a reverse mortgage. To qualify on a reverse mortgage, we're kind of buzzing through this presentation, and so hopefully if you have any questions at the end, please bring them up, but we'll just kind of keep humming through this. Those who qualify for a reverse mortgage, number one is the home has to be your primary residence. We can't do this on investment properties or second homes. However, you can do a reverse mortgage on a primary residence and use the equity in your primary residence to buy those other homes. And so if you wanted to pull $200,000 out of your primary residence and then go buy a second home or go buy an investment property or go buy an Airbnb, all that is totally fine. How you use your money is your business. And I have a lot of clients who will do that because what a great investment opportunity that is for them. They can take money out of their primary residence. They're being charged 5% or 6% or whatever the mortgage interest rates are. They can take that money without a mortgage payment and go buy an investment property. Now they own two properties that are appreciating at 5 to 10% a year. This one's cash flowing for them. And when they pass away, everything goes to the family and the homes can be sold. and the family keeps the assets that are left over. And so again, it's a great alternative for somebody in retirement to add additional monthly income by expanding their portfolio and buying additional rental properties. Second requirement is that for the standard reverse mortgage, at least one homeowner must be 62 or older. There are loans that allow for ages as young as 55 and older now. Generally, I don't recommend those unless it's a very specific situation, but it is an option. And then finally, we need to have a minimum equity requirement. In order for these loans to not end up as a disaster, we need to make sure that there's enough equity in the home to make sure that the mortgage doesn't grow too quickly. And so what we do there is that we take roughly 35 to 60% of the home's equity and we leave it alone. We just leave it in the home. The bank's not taking it. You don't get that. It's left in the home until you pass away or sell the home, and then you get access to it. The remaining portion of the equity is what we can use to pay off mortgages, pay off debts, or set up that line of credit, as I mentioned. One of the primary questions that comes up for a lot of our clients is, okay, so what happens when we pass away? The bank gets everything, right? Absolutely not. Absolutely not. When a homeowner with a reverse mortgage passes away, again, the best way to explain this is to refer back to a standard 30-year fixed mortgage, because it's the exact same outcome. If you have a reverse mortgage, your family has the option to keep the home, they refinance it to pay off your mortgage, and all of the equity that's in the home now belongs to them. They can cash out, they sell the home, they pay off the mortgage balance, and whatever equity is left over is now in their bank account. And number three, they could walk away and let the bank foreclose. In the old days, this is usually what happened on reverse mortgage. The original reverse mortgage was designed badly, and the loan was designed to grow too quickly. And this was an issue for the banks and for homeowners, because if the mortgage grew faster than the home's appreciation, you eventually went upside down and there was nothing left over. But the new reverse mortgage is the opposite. The loan is designed to grow slower than normal appreciation rates, so that even though your mortgage is growing, your home's value is growing faster, so that for the vast majority of our clients, if they do a reverse mortgage today, 10, 20 years from now, they will almost surely have more equity at that point than they do today, even if they never make another monthly mortgage payment. And so it doesn't really make sense for the family to walk away from the home, because the vast majority of reverse mortgages will never go upside down. There will always be money in the home for the family to inherit. And so it's better for them to sell it, get a realtor, get the market value out of it, and take care of it. These loans, reverse mortgages, are non-recourse loans, meaning that if that were to happen, if somebody were to live to be 120 and home values plummeted and the home was upside down at some point, FHA is insuring the mortgage. So the family can never be held responsible. The bank can never come back on the homeowner or their kids and say, hey, we're losing money, you got to pay us, right? FHA is covering those losses. Let's give you a quick example, because a lot of people get lost in what I said previously, that I can eliminate my monthly mortgage payment and yet somehow my equity continues to grow, right? It seems like a contradiction. So let me give you an example of why this works and how this is such a great thing for people going forward. So let's use this example. We have a $400,000 home. Our homeowner has a $400,000 home. Average appreciation rates in our nation have averaged right around 5% since 1970, and that's including the great crash of 2008. But let's go off of a conservative 4% appreciation rate, right? Let's imagine this homeowner at their age can borrow $200,000. They can take 50% of their equity up front, and so they now have a $200,000 mortgage on a $400,000 home, and the combined interest rates are about 5%. Now, I know interest rates today are a lot higher than 5%, but 5.5% is our long-term average, and expectations going forward as well. So that's why I'm using that number, but the numbers still work even if we plugged in a higher interest rate. But let's walk through this. So on day one, the home's worth $400,000. The mortgage balance is $200,000. The remaining equity is $200,000, right? Basic math. After 1 year, the home value will go up to $416,000. The mortgage balance, the homeowners made 0 payments over the past year. They've saved about $12,000 in mortgage payments. The mortgage balance itself went up to $210,000. The end result, the total remaining equity, if this homeowner sold this home 1 year from now, their equity would have grown from $200,000 to $206,000 over that 12-month period. And this continues to be the case as we go forward in time because it's compounding, right? The home value compounds at 4% on average annually. The mortgage does grow, compounded by that interest rate. But because the home value is growing faster than the mortgage, the homeowner's remaining equity is actually continuing to increase over time. 25 years down the road, it still holds true. The equity is growing faster than the mortgage itself. Let's move forward. I want to make sure that I give enough time to cover some scenarios. The basic loan types that we can use on reverse mortgages. The first is traditional fixed rate. That is what it sounds like. The second is a growth line of credit. I'll come back to that one. But the traditional fixed rate is what it sounds like. Your interest rate's fixed forever. You set it and forget it. And if anyone is doing mortgages this year, my recommendation is look seriously at doing adjustable rates this year. The reason for that is because with interest rates starting to come down now, doing a fixed rate is essentially locking yourself at the top of the mountain. And so it may or may not be the right thing for you. I know a lot of people are leery about adjustable rates, but as interest rates are coming down, it definitely, I recommend you look at it as an option to do an adjustable interest rate now so that your interest rate floats down with the market. And then as interest rates stabilize at a lower rate, you can look at doing a fixed rate again to assure that up. Other things about the traditional fixed, if you're doing a refinance, you only get one draw at closing from the equity in your home, no future draws. We use this typically as a set it and forget it. You know, you're paying off your mortgage or you're buying a house and you just never have to think about your mortgage again. That's kind of the benefit of this loan. The growth line of credit is more of a financial planning tool. Now, it does come with an adjustable interest rate. That is the one downside to this loan because, again, when interest rates are low, you have that risk of rates going up like they have on us. But the benefits of the growth line of credit is that you're only charged interest on money you've actually borrowed. And so let's go back, bringing back that scenario I gave you just a moment ago. Imagine you have your borrower, they have a $400,000 home and they have the ability to borrow $200,000 against that $400,000. But let's say this person doesn't need that money. They just say, yeah, I've got it set up now. Now I have that money if I ever need it, but I'm good. I'm going to leave it alone for a bit. They're only charged interest on what they've actually borrowed. So if they haven't borrowed anything, they're not being charged any interest, right? But the other benefit to that is that as long as the money is in their line of credit, it's going to grow by the same interest rate that they have on the mortgage. So if they have a 5% or a 6% or a 7% interest rate on their mortgage, but they haven't borrowed anything, they're not being charged anything. But likewise, that $200,000 that's in there is growing by 5, 6, or 7%. And so it's a great place to store your cash. It's non-taxable. If you take money out, you cannot be charged taxes on it. The government doesn't see it as an income. And so I have clients that will really take advantage of this. You know, they've got their CD where they're getting 4% and they can't touch it for 3 years, right? Plus it's taxed when they do draw it out. With the reverse mortgage, if they put that money into their reverse mortgage, not only do they pay down the balance of their mortgage and reduce their interest charges, but now they're getting that 6, 7% growth rate, and it's accessible all the time, never taxable. And so again, it's a great way for people to access the equity in their home, to grow their assets, to give themselves more flexibility and opportunities. So this next section, as I'm wrapping up, is a few clients or scenarios that we work with on a general basis. This gives you an idea of who's doing reverse mortgages and why they would do it. This first one is Widow Sophia. She represents a woman that came to me early on when I started my company. She had just lost her husband. And when he passed away, she lost him, she lost his income. Now she's left with a fixed monthly income of about $1,500. She has a $1,200 mortgage payment. She has a $300 car payment. She has credit cards and insurances and gas. By the time she goes to buy groceries, it's gone. She has no more money. And so essentially she was bleeding out financially. She had, I figured, about 8 more months left before she was bankrupt. And so with the reverse mortgage, we were able to consolidate everything. We paid off the car, we paid off the house, paid off the credit cards. We gave her a line of credit for $40,000. And so for her, it was absolutely life-changing. She went from being upside down every month to having excess every month, plus having a $40,000 reserve account in her line of credit. And so for her, it was life-changing. This is one of those situations where you get a lot of tears and hugs at closing. She's the exact reason why I started doing these loans exclusively, is because, again, for someone like this, it's life-changing. It is absolutely transformational in the type of life that she lives, when we can make those kind of improvements in her life. This is the Griswolds. The Griswolds are about 75 years old. They want to sell their home and downsize, but they have one primary issue. They only have $300,000 to buy their new home, and their goal is to avoid what happened to Widow Sophia. If he passes away, they want to make sure that she's going to be protected for the rest of her life. So what can they do? If they leave, if they're out shopping for a house right now, they could find a $300,000 home. Most likely that's going to have its restraints. I know here in St. George, that would probably be a double wide manufactured home, or a townhome with stairs. And so they're very limited on what they can do to buy a home and have no monthly mortgage payment. But if they use a reverse mortgage, they could buy that exact same home, but they only put $140,000 down. They keep $160,000 of their cash in the bank. They still own this home, the same home, with no payments. And so again, it opens up a couple of opportunities. But for most people, it's about purchasing power. They take their $300,000 and they can upgrade to a $650,000 home, a home that's going to work for them for the rest of their lives, a home that has single level in a neighborhood with friends and people that they can stay active with. And so it completely gives them a new opportunity to buy something that is a much better fit for them and their family, or for each other. This last scenario is Jerry Seinfeld. I get this feedback a lot. People will come in, they'll talk to me, they'll say, you know what, I love this. This sounds really good, but I just don't need it right now. I'm 62, I'm young, I'm going to work another 10 years. I have plenty of money to make my mortgage payment. I'll come talk to you in 10 years. Now, my advice on this is well, let's reconsider that and look at your other option, because if you play out side by side, a conventional versus a 30-year fixed, you'll find that if you put a 30-year fix side by side with a HECM, you'll see that the HECM has a lot more opportunity. So the option one that he has is we say, okay, you keep your current mortgage. You've got a 5% interest rate. Your balance of your mortgage is $200,000. You pay about $1,100 a month to the bank. 10 years later, you will have paid the bank $131,000. But of that, about $80,000 goes towards interest payments, and it's gone. You can't get any of that back. With a reverse mortgage, you have the option to do the exact same thing. Similar interest rates, similar loan balance. Your payment becomes voluntary, though. So if you want, go ahead and make that $1,100 payment. 10 years from now, you will have paid the bank the exact same amount of money. But here's the benefits of having a HECM. Number one, every dollar you put into your mortgage was voluntary. It paid down your mortgage balance, but it also added to your available line of credit, and everything in your line of credit was growing by the interest rate you had on the mortgage. And so you've averaged a 5% growth rate on that line of credit. At the end of 10 years, you don't have $130,000 of equity in your home. You have $170,000 you can draw out with the line of credit. And then, as I mentioned, it's also non-taxable, fully accessible at any point. To wrap up, so we have some time for questions. Again, just recapping, primary benefits of this loan is to eliminate the monthly payments and expenses, pay off bills and consolidate debts, live with freedom and flexibility, peace of mind, and help people make the most of their retirement, help people to avoid the necessity of having to go back to work in their 70s and 80s just to put food on the table. So if you have any questions, if you have any clients or friends or family that are struggling financially, obviously we would love to help them. I'm licensed in about 10 states now. But I'm happy to counsel and give advice to anybody anywhere in the country. And so if there's anything I can do for someone, let me know. But any questions?
Trevor, how common is it for people to look and convert that home equity and buy an investment property to help supplement their retirement?
Not as common as I would like it to be, but it's gaining a lot of steam, because there's two scenarios there that would be beneficial. Number one is that these loans could be used on a 4-unit, up to 4 units. So imagine somebody, they take their money, they buy a 4-unit property, they live in one of the units, and then they rent the other 3 out, and it's strictly cash flow for them in renting those 3 properties out. That one I've come across a couple of times. The more common is guys that they own their home free and clear. He wants to flip homes, or he wants to buy a couple of investment properties. And so we set up his line of credit. The flipping home is probably the most common. Is somebody will set up a $400,000 line of credit. They'll find a flip. They can draw $300,000 within a couple of days. They flip this home in 6 months, get the money back. They pay their reverse mortgage back down and put the money back into their line of credit. And they're only taxed on the profits they made in flipping the home. And so that's probably the more common scenario. But I do have a few clients likewise that have, taken $200,000 or $300,000 or $400,000 out, went out and bought a couple of townhomes and cash flowed those properties. So that now they have 3 properties or 2 properties that are appreciating, but no payments on any of them. So
That's awesome. I hadn't thought about that aspect of the reverse mortgage. So thank you. Any other questions for Trevor? All right. Looks
Okay.
like you're done. So I appreciate you, Trevor.
Awesome.
As always.
No, I appreciate you.
So thanks again. We'll let you
Okay.
go.
Thanks, Derek.
Bye. All right, so hopefully you guys are enjoying it so far as we're putting it together. We're always looking, one, to make sure that you're informed on market and different investment options for you, but then two, also to keep you informed on what we're doing in partnerships and how we're protecting you. We've got a few more minutes if you would like to hop on, get a drink, stretch your legs again, for ROPA with Rent Dynamics to come on. But this right here, I'll give just a little bit of an intro. With what they're able to do, it's really empowering for the tenants, and in a lot of ways is life-changing. We've worked with many tenants that haven't had the best credit, and as we know with credit, how much it impacts really every aspect of your life now, from just regular insurance for your car and renter's insurance and getting loans of any sort, has a huge impact. And so as there wasn't really a way for tenants to report on have their rent reported to the credit to be able to help balance out their largest payment, and get credit for that. And it was a way to help kind of, the way that was in essence, keep perpetual renters. But there's starting to be a trend now. You see Rent Dynamics, you had Azusu and a few others start to do some basic rent reporting. And as that increases in popularity, it'll have a huge impact in people's lives and their financial well-being. So